Welcome back. Oil is steady near $90 a barrel this morning as tight global fuel supplies are drawing investors and speculators back to the market. Crude is up about 32% since late June. Our next guest is a prominent oil bull and says oil will be trading between $85 and $105 per barrel for the next year at least. We're joined now by Eric Nuttall, Senior Portfolio Manager at Ninepoint Partners. Thank you so much for joining us.
You bet. Great to be here.
This was going to be a debate between yourself and somebody who's much more bearish on crude oil. He had a scheduling mishap and so is not here. So I'll do my best to put some of his arguments to you. He thinks more oil is coming onto the market. He thinks that the recent move by Russia and Saudi Arabia to curtail production is not going to last forever. He also says the so-called Fragile Five, which are a bunch of troubled nations like Libya, Iran, Iraq, Venezuela, are also adding more to supply. So why don't you address the supply question first?
You bet. I'm profoundly disappointed. I was really excited for this morning. I spent the weekend preparing because I get the reputation as a perma bull, and his reputation is that of a perma bear. Mm-hmm. When I looked at his analysis, the difference in opinions, we share some common views, but the two biggest differences revolve around demand. His demand forecast, not even for next year, but where we sit today, is in dire opposite of what everybody else believes. He's running about 100 million barrels per day of current demand. Other firms we use, like an Energy Aspects, a Goldman Sachs, a Morgan Stanley, are 2 million barrels higher than him right now. And so the starting base looks too low. On Twitter today, I put up some graphs from Rystad that shows that global diesel demand, global gasoline demand is back to 2019 levels as of Saturday. So like very real-time data. So that's a key difference of opinion. So that's 2 million delta. Secondly, I share his view that we do have production growth from some areas like the United States. We're looking for about 300,000 barrels per day of growth, modest growth in Canada, Guyana, et cetera. But the big delta really is in OPEC, where he had meaningful growth next year from Iraq because there's a pipeline that's been under dispute and this belief that you get all this oil. Our sources indicate that the oil that was impaired flowing north was already flowing south. And so there's not this big resumption, this surge of production. That's a 700,000 barrel per day delta, which is huge. And then in terms of Iran, there has been a softening in sanction enforcement on the part of the United States. I think they are terrified about a rising oil price, that what that means for gasoline prices and hence the presidential approval ratings again in Iran.
Right.
But our sources again say that outside of China as a buyer, crude buyers now are not willing to buy incremental Iranian barrels because of fear that the U.S. government changes their mind and suddenly starts to enforce. So that's about 1 million barrel per day delta. So you start with a basis of demand being 2 million barrels too low, OPEC supply being 1 million barrels too high. Well, that's a 3 million barrel delta. Mm-hmm. So where do we sit today? Inventories are falling at their fastest pace in history. We sit at a material deficit to any baseline that you want to use. From our analysis, when we look at the will and intent of His Royal Highness Abdul bin Salman, the Minister of Energy of Saudi Arabia, the most capable energy minister we believe was Saudi, wanting to offset the negative impact of the SPR release of last year. Mission accomplished so far.
Strategic Petroleum Reserve.
Or Strategic Political Reserve. So they've accomplished that. We think they will extend their cut through Q1 of next year into Q2. Due to ongoing volatility in the price, concerns about China, whether the economy will eventually do a faceplant or whatnot.
You don't think the Saudis will conclude that $100 is too much and that $100 will blunt demand? So
you in the opener, you were correct in that. My view is we're going to trade in a range, roughly between 85, which I feel like is a good floor, and around 105. And I think there will be a sensitivity that if there is a mass over-tightening, which we forecast, and the oil price does go too high, it will be beholden on those that have taken barrels off the market to slowly and rationally return them onto the market. Because there is the prospect of, another SPR release potentially next year, less than what the prior one was. I would say that the staying power of Saudi Arabia versus the U.S., SPR is incomparable. Mm-hmm. So we're not calling for $150, $200 oil in the next year. We do think there is a ceiling. But then when we relate that to energy stocks, there's just such a massive disconnect because energy investors, it's been a tough go. Past couple of years have been good, but prior to that were hellish. And so many investors still suffer from PTSD. They just don't want to get hurt again. So they see $90 and they say, well, gee, it's just because of Saudi, it's just because of OPEC cuts. They don't realize that this is the strongest fundamental market I think I've seen in my 20-year career, but the stocks have been lagging. So ultimately what I think is the free cash flow that is being generated right now is the highest in history. The balance sheets of these companies are the strongest in history. And in the coming months to quarters, months for a couple large caps, quarters for some mid caps, they'll finally get to their final debt targets. They'll trigger 75 to 100% of that free cash flow coming back to us. And we have some mid caps like a Baytex. They're trading at a 34% free cash flow yield. Sorry, 41% free cash flow yield. It's so big, I don't even believe it. At current oil price, $90 oil. And well, we're getting half of it. So they are paying us actively now on a run rate go forward 20%. In terms of buybacks. So it's that massive buyback from the sector that I think is going to drive the re-ratings.
Yeah, this has been your narrative for a while now.
Yes.
Are generalist investors, big fund managers, back into these stocks, or are they still hesitant?
God, no.
You've been waiting a while for those big investors to step in.
Still waiting, which is why we enacted our Plan B. And our Plan A was the people realize how good the macro is. They'll want to commit. The sector's free cash flow yield is on average, 14% to 16% in $90 oil versus tech at like 2%. People would see how good it is. That's Plan A. I can't count on that. So we enacted Plan B, and the B is for buyback. And so we championed the sector, took a year, convinced everybody, and the highest path to re-rating is for meaningful buybacks funded out of free cash flow once ultimate debt targets are reached. I've been overly optimistic. We were wrong on the oil price for part of this year. It was weak earlier this year for other reasons. So that deferred what we thought would be inevitable by 6 months. Well, we're here now. So we're in September, almost October. By November, December, we have 2 large caps reaching their final debt targets, inflecting to 100%.
Yeah, those are?
BCNQ and Cenovus. So they should be by year end, give or take a couple weeks to a month in either direction. But when these companies start paying out 14 to 16%, Cenovus would be like 18% at $90 oil. Whether that's a dividend, a buyback, likely a combination thereof. I think the attractiveness of that will be so irrefutable that it will drag the generalist investor back. And if not, it has to drive the re-rating anyways. My
very simple observation is that on a daily basis, when crude is higher, meaningfully higher, the stocks move higher. But when it moves lower, the stocks move lower.
Yes.
Again, you believe that oil can, let's say, hover at about $90 for the next year or so. And at some point, these shares, these oil stocks will make sustainable advances forward.
Yep. I really want people to understand. We do not need oil to go any higher from here for these stocks to do phenomenally well, because the amount of free cash flow that is being generated, like I referenced Baytex, at a 40% free cash flow yield at the current oil price, well, they can buy back every single share that's standing out of free cash flow in 2.5 years. Well, they have a lot more than 2.5 years of inventory. So the large caps, again, we've got 14, 18, 19% free cash flow yields at the current oil price. So banish from your minds the thought that, well, geez, we need $150 for these companies to do well. At $90 oil, we're talking about like the most unbelievable environment for free cash flow for the companies. Ultimately, that will be reflected in the share prices of those companies. People are hesitant. They want to see stability in the price. They don't want to see this crazy volatility like we had earlier in the year. March oil falls 15% in a week due to Credit Suisse and all these exogenous things. Seeing will be believing. And you will see the action of the companies using their free cash flow buybacks in the coming months to quarters. And finally, the market at some point will start to believe it.
Do you prefer large caps or mid caps, or do you really distinguish between the two fundamentally? I'm
still hunting for multi-baggers now. It's more difficult than it was 2 years ago. We still think we're finding them. Like I can buy, again, I reference a company, Baytex is a big holding, it's at 11% weight. It's trading at 2 times its cash flow at $90 oil and a 41% free cash flow yield at the current price. Well, we think this sector re-rates to a 10% free cash flow yield. So to go from a 40% to a 10, you've got significant potential upside. Large caps, we still see good upside. The prospect of being paid a 14, 17, 18, 19% dividend, ultimately, that drives a re-rating down to 10. Well, that's a doubling. So we still see meaningful upside in stocks. There's such a massive disconnect between where oil trades and what these energy stocks are discounting.
Remind us, lastly, of the funds that you manage for Ninepoint.
So I run 2. The one is the Ninepoint Energy Fund. It's by far the largest in Canada. At one point, it was the 3rd largest actively managed fund in the world. And the second is the Ninepoint Energy Income Fund. Smaller, it's about $275 million. Its intent is to glean as much income as we can from owning high-yield stocks plus writing covered calls. So we've got two different funds trying to achieve two different things. Our flagship fund, we work day and night trying to maximize the amount of money that we can make for our clients from our macro calls. We're not always right. I think we've done a decent job of calling it. And then the income fund is, again, trying to generate income for our clients.
Eric, thanks.